The perfect age to start investing can vary depending on individual circumstances, but generally, the earlier you start, the better. Many financial experts suggest that people start investing as soon as they have a steady income, which could be in their early 20s or even earlier if possible. The power of compound interest means that the more time your money has to grow, the more potential you have to build wealth over time. For young people starting out, here are some common investment options. Employer-sponsored retirement accounts, 401k in the US if your employer offers a 401k plan, especially with a matching contribution. It's usually a good idea to contribute enough to get the full match. This is essentially free money added to your retirement savings. 2. Roth IRA *. A Roth IRA is a retirement account that offers tax-free growth and tax-free withdrawals in retirement. Contributions are made with after-tax dollars, making it a good option for young people who may be in a lower tax bracket now than they will be later in life. 3. Index funds and ETFs *. These are low-cost investment funds that track the performance of a market index like the S&P 500. They're a great way to get broad exposure to the stock market without having to pick individual stocks. 4. Individual stocks * for those willing to take on more risk. Investing in individual stocks of companies they believe in can be an option. However, it's important to research and understand the companies before investing. 5. Real estate crowdfunding *. Some platforms allow you to invest in real estate with relatively small amounts of money. This can be a way to diversify your portfolio and get exposure to real estate without needing to buy property directly. 6. Cryptocurrency *. While highly volatile, some young investors are drawn to cryptocurrency as a high-risk, high-reward investment. It's essential to only invest what you can afford to lose in this space. 7. Savings accounts or CDs *. While these offer lower returns, they're a safer way to start building a financial cushion before moving into riskier investments. Starting early, focusing on long-term growth, and continuously educating oneself about investing are key strategies for young investors.